Hey everybody, it's Chris Miles, cash flow expert and anti-financial advisor. Hey guys, I'm excited to talk about something really quick with you about a question I got from an insurance agent. He said, "Hey Chris, is it better to pay off the mortgage by putting the extra money in there, or should I be using the whole life policy to do that?" And I said, "Here's how you show the numbers, right?" Now, this person's situation, they just refinanced to a nice low rate, like a 3% mortgage rate. And we ran the numbers at 184,000. They want to put an extra $1,000 a month onto their payment. So their payment's like $776 a month. They want to put an extra $1,000 a month. Well, if they did that, they would pay it off in exactly 10 years, right? Now that's if you put the money in your house. But what if you took that extra 1,000 a month or 12,000 a year and put that into an insurance policy where it builds up inside of it tax-free and protected? And so I said, hey, let's just see how the numbers come. And I already knew the answer to this, but I wanted to point out some key things with it. So I showed him first, this person was actually putting in 6,000 a year into the Roth IRA. I said, great. I'm taking this person as being a 40-year-old. I didn't know their age, but I just took a basic age of 40 years old, used my own name, of course, in there. Now that $6,000 a year, normally if you put that money in, after 10 years, you'd have about $70,000. So I told him, I said, this is the thing you have to compare is if you're putting in 6,000 a year into whether it's the life insurance or Roth IRA, doesn't matter. But if you're putting that in, the 12,000 has to be on top of it. There's got to be more after 10 years to pay off that mortgage than if you just put the money in, right? Because either you put the money into the mortgage and it's gone, it's in the bank's hands, you no longer have the control of that money, or you keep the money in your control and then you use it to grow. Now, again, this is just using the life insurance, right? So here's the difference. Instead of 70,000, putting that extra 12,000 a year or $1,000 a month in there, voila, instead of 70,000, we got 213,000. So the difference was just over $142,000. Now, if he only paid the minimum payment on his mortgage during those 10 years, he would have a balance of just under $140,000. So what does that mean? If he owes just about 140,000, he's got 142,000 and change in here. He's got money enough in the policy to pay off his mortgage anyways. Now, he was only ahead like $2,600, right? So it wasn't like this made a huge difference putting the money inside the policy. That's the big fallacy. It's not like this massive, huge difference that you're making millions of dollars more just letting it sit in a policy versus sitting inside the bank's hands for your house. Here's the key difference though, is that one, and I learned this from the last recession, when I paid extra equity into my home, I can't get that money back out when I need it, especially if you need it because there's job loss or an income somehow has been sacrificed or something has happened to your income that now you need the money. If there's an emergency, you cannot get to that money from the bank. They never want to give you money when you need it. So your only option is to try to sell the house, and you're likely to sell the house for less than what it should be selling for because you're going to have to try to get that money out quickly, right? So that's one problem is that one, if you have the money inside the policy, in case of any emergency, you can get to it. You can get to it in about a week and a half. So it's not like having to go through a mortgage company to ask for permission. It's like asking mom and dad for the car keys of the car you own. That seems ridiculous to me. So that's one big thing right there. I wish I'd understood that during the last recession when I put extra money down on my house, only realized I couldn't get it back out when I really needed it. Two, in case of creditors or lawsuits, if they happen to win, they can put a lien on your house. So if you've got equity in your home, that's bait. That's easy target money for someone to be able to take, whether it's through a judgment because there's a collection against you, or two, because somebody won a lawsuit, they're going to put a lien on your home. So when you sell it, you have to pay them off, right? You can't ever get access to that money otherwise. Where in the life insurance in most states, California is one of those exceptions, but in most states, you have 100% protection of this money. So they cannot put a lien or anything on this money inside your policy. So it's protected. It's actually better protected than putting it in your house. So ironically, the riskier thing you should be doing is putting extra money into your home by paying down your mortgage with extra payments. That's the riskiest thing you can do because now the money's out of your control. The safer thing to do is get it out of everybody else's control and back in your hands. And that's the key what happens here. And by the way, just as a bonus, yeah, there's a much bigger death benefit too. 1.1 million versus like 370,000. So you have about $700,000 to $800,000 more of death benefit that you got, even though you have the same extra money too. So that's just an additional perk. So, and by the way, would I pay off my house? No, I actually would not use my policy to pay off my home. Currently, if I had to, I know I have the option. But what would I be doing over those 10 years instead? I personally would want to invest this and buy other real estate. I would want to buy things that create cash flow for me now because I know that cash flow creates freedom, right? That's the key, because if I can take that money and now invest it, now I'm making more money. I can actually make more than the mortgage payment in cash flow by those 10 years. Pretty much my mortgage payment would be paid for anyways. So that's my own personal philosophy. I'm not saying that's a recommendation. The key is here is that when you have money in your control, you have more options by putting the money and putting the equity into your hands versus a bank's hands where the money's now out of your reach. That's risky. So I hope this is valuable for you guys, because I know it was for that person as well. So anyways, guys, you got any questions, you can always go to moneyripples.com and check out more information, or check out our podcast, The Chris Miles Money Show, where we got lots of great info on there too. So guys, we'll talk to you later.